Hello again, everyone. It's Costa G. Welcome back to the MSU Wealth Management Association podcast. My guest today is Barry Ritholtz. Barry is the chairman and chief investment officer of Ritholtz Wealth Management. He writes a blog called The Big Picture and records a podcast for Bloomberg called Masters in Business. In addition, he is a featured columnist at the Washington Post. This episode will be the first in a two-part series with Barry, so be on the lookout for part 2 coming soon. We've got a great episode for you, so stay tuned. Hello, Barry. Glad to have you here, and thanks for sitting down with us today. So I wanted to just kind of start off with talking a little bit about your background. So maybe a lot of our listeners are undergrads, maybe looking to get into wealth management. So if you could kind of take us through maybe your experiences from undergrad into where you are today.
So I took a career path that I wouldn't really recommend anybody else doing. It's a little wacky. Undergraduate, I originally thought I was going to go into the sciences. I was a double major, applied mathematics and physics. It didn't take me very long, like about 2 years, to realize I was pretty good at math and science, but there were people at school who were just fantastic, and I was not planning on competing with them. And so I turned my 4-year college degree into a 5-year plan, switched to political science with a minor in philosophy, which prepares you for exactly nothing. And so I came out of school, worked a couple of years, and the joke is, hey, you grow up a Jewish boy on Long Island and you don't know what to do with your life. The rule is you have to go to law school. It doesn't matter if you want to be a lawyer, it's just the rule. So I did that and found I really enjoyed law school. It was intellectually challenging. It was fun. It was fascinating. I've discussed previously how really amazing the practice of law, the study of law historically is. And then you get out into the real world and you find it's just a tedious, grinding bore. And the stat is, after 7 years post-graduation, 50% of law students are not practicing law. But it's, like physics, like math, it's a rules-driven industry. It's a rules-driven field. And it forces you to think in terms of syllogisms. What are the facts? What are the previous patterns? What can you extrapolate from the prior history? What shouldn't you extrapolate? And so it turned out to be really, really good training for finance, almost accidentally. And you'd be surprised when you look around the world of investing and trading and fund management and analysis. There are a ton of former attorneys applying their wares in the world of finance. It helps to think critically and analytically. One of the things you learn is active reading, how to read with a purpose, how to read to look for a really specific facts. What are supported by the evidence? What is opinion? What's hypothesis? What's unproven? Really, those critical analytical skills make a big difference when you're studying anything involving finance. What potential risks there are? Are we going to have inflation or deflation? Are stocks fairly priced, and what does that mean? You end up learning a lot of things, and you don't take for granted a lot of what is assumed by average investors. So I found, not that I would recommend people spend 3 years in law school. It's way too long. It really should only be 2 years. But it really was a good training for finance.
Awesome. So then how do you think that students can kind of gain that ability to read with a purpose without necessarily going to law school? Are there certain classes or anything that would help with that?
Yeah, absolutely. So first, any form of logical reasoning, rhetoric, any of the more philosophical ways of looking at the world as a series of puzzles to be solved is very helpful. That's number one. Number two is statistics and probability, because investing is a probabilistic exercise, and most people don't look at the world that way. Most people look at the world as a series of things that possibilities, almost binary. Hey, we're recording this before the election, and the outcome is binary. Either one guy's going to win or the other guy's going to win. And that's the wrong way to think about it. When the weatherman says 90% chance of a beautiful day tomorrow and it rains, doesn't necessarily mean the weatherman was wrong. It means the models that predict what is left. Hey, we have a hurricane coming up the coast. It's supposed to head out to the Atlantic, and we've had nothing but rain here for the past week. It's been 2 weeks ago. This was supposed to be a beautiful sunny fall, and now it's just been pouring, literally pouring for a week. Now, if the model is correct and the hurricane turns towards Europe, tomorrow is going to be a beautiful day. But there's a 10% chance that that's not going to happen. So if it's supposed to be sunny tomorrow and it's ugly out, was the weatherman wrong, or did the low probability outcome occur? And most people have a hard time with that. Our brains aren't really built to think probabilistically. We love a good narrative, we love a good story, and we have a tendency to focus on that. So any class in statistics, probability theorem, those sort of things are great. And then one of the most useful exercises in law school, but not for the reasons I think lawyers think, is moot court. Moot court is like any debate society. So in college, I doubt there may not be something called moot court, but there may be a debate group. And the key to debating is the ability to, so when you go into moot court, you and your team, all the teams are given a set of facts, and these are the laws that apply, and you have to argue your side. Some schools, when you get to the finals, you could get tapped, and if you were on one side, well, the next round, you may have to defend the other side. And that really forces you to look at the world as a series of not lopsided, one side is right and one side is wrong, but a series of very nuanced, very balanced arguments, pro and con, about different things. Now, let's apply that to investing. Do I want to buy this stock? Do I want to sell this stock? Do I want to be long the markets? Do I want to be short the markets? The strongest thing that moot court teaches you is you cannot take one side of any position unless you really understand the opposite side. And all of our confirmation biases and all of our cognitive errors very much lead us away from that. And let me tell you, if you understand why somebody is a seller of Tesla and you really understand the argument, that makes you a much better potential owner of that company. Because let's be honest, most things in life are fairly balanced. When you see litigation, you're only seeing the 3 or 4 or 5% of disputes that go to court. And that's true whether it's a civil dispute about a contract or a criminal prosecution for someone who's violated the law. Hey, when you're really guilty and you have no evidence to support your side, well, you're going to try and settle that case, because otherwise you're going to spend a lot of time and money to ultimately lose anyway. So why not, be more efficient? That same sort of approach should color the way the investors look at the world, whether they're bullish or bearish, whether they like this sector or not, whether they're long or short, whether they think the inflation is going higher or lower. They should understand both sides of the argument, because really, if you just look at the world through one lens, everything you're going to see is you're going to seek out things that confirm your belief system and avoid that which challenges you. One of the hardest things I do every day is to try and find and read something that is the opposite side of the position that I'm taking. And when an exercise I do every week is I put together our succinct summations of the week's events. And I purposefully make sure that it's 5 or 6 or 7 positives or 5 or 6 or 7 negatives, because it prevents you from adopting a position regardless of the data. And I'm reminded of the great um, admonition that Solomon supposedly either was told or told someone else: "This too shall pass." And no matter what you're thinking, bullish or bearish, you have to be aware that that's a temporary condition. Yes, over the long haul, stocks have a tendency to go up. There hasn't been a 20-year period in U.S. history where stocks weren't net positive over that period. But just because it hasn't happened previously doesn't mean it's not going to happen in the future. Unprecedented things occur all the time. It's sort of weird. Every time I hear someone say, well, that would be unprecedented. Hey, before we were the Wright brothers, flying was unprecedented. I could show you, before the polio vaccine, ending polio was unprecedented. Things happen with surprising regularity, and we should understand that.
No, absolutely. And I don't want to go like too deep into the weeds here because I've got some other topics that I wanted to touch on. But so when you say you can kind of see both sides of an argument, how is it then that you can sort of take a position and defend it without being too swayed by the other side necessarily?
Well, because ultimately you have to exercise judgment as to what is the strongest probability of a future outcome, and recognize that it is probability. So what I just said earlier about the tendency of stocks to go up over the long run, I could give you a dozen other examples of little things that argue against holding on to equities, but when you come down to the final assessment, most people are not going to be able to market time. Most people are not going to be able to pick stocks. Most people are not going to be able to manage their own behaviors. All of those things point to a preponderance of evidence suggesting the average investor is better off passively indexing and just avoiding everything else. Now, that doesn't mean there aren't Jim Simons and Stevie Cohen's in the world, or Ken Griffin's, or go through the list. But for the average person, just as, hey, I used to play a lot of pickup basketball. I'm not Michael Jordan. And the average player, even in the best, college teams, are not going to be LeBron James or Michael Jordan. Similarly, the average trader is not going to be a Bill Ackman. That's not likely to happen. And so, again, back to probabilities, might you be the guy that can hit, 400? Might you be Ted Williams? Might you be the trader that's going to outperform the market consistently over time? Well, sure. Bill Miller has done it, and Bill Danoff, and there's a run of people who have put up incredible track records over decades. But and of course, Warren Buffett, and go down the list. But these names are memorable because they're the outliers, and the vast majority of managers, net of fees, consistently over any 10-year period of time, the average person is better off indexing. And so where we try and bring value as an advisory firm is not just in the portfolio construction, but in all of the planning and behavioral controls around that, essentially to prevent people from shooting themselves in the foot, because that's what history shows us the average investor has a tendency to do. Not everybody is going to stink the joint up all the time, but it happens so regularly, it's hard to ignore.
Yeah, and that's a great actually segue into the next topic. So I want to talk a little bit about, obviously you've been in the industry for quite some time, and you've probably realized some trends that have happened. So I want to talk about maybe some long-term trends in the wealth management industry, how it's kind of evolved, and then maybe some shorter-term trends, maybe 3 to 5 years that you see kind of going forward.
Sure. So let's talk about some things I've gotten right and some things I've gotten wrong. And the old joke amongst traders are, there's no difference between being early and being wrong. So let's start with that. I continue to be shocked and amazed that the old school wirehouse, broker-dealer, commission-based, lack of fiduciary model continues to exist. I don't get it. It never made sense to me. I never was on that side. I never worked as a broker, although in a firm where I was an analyst, they worked me through every department. You do a month here, a month there, and so I spent a month on the phones with them, and it was like, oh my God, how do people do this? But that model of, look, your doctor has a Hippocratic commitment to you. Your lawyer and accountants are your fiduciaries. They're working on your behalf, on your best interest. I never understood why anybody who's providing financial advice was more akin to a used car salesman than they were to your lawyer or your accountant. That just never made sense to me. And actually, some people have said, well, at least, new car salesman, there's a lemon law in place. So if you get stuck with something, if you get stuck with some structured product that collapses, you can return it. No such luck in the non-fiduciary world. And we came very close to getting a uniform fiduciary law. So on the one hand, I've been completely wrong about that business model going away. To give myself a little credit, overall, the trend has been towards fiduciary, away from transactional, towards fee-based, fee-only, and no conflicts, away from commission. And even the big wirehouses, UBS, Morgan Stanley, Merrill Lynch, et cetera, they've all added a sort of RIA-like business to their model. Now, they're kind of hybrids, and so the danger is, okay, now I'm an RIA and I serve your best interest, and then they casually don't mention, okay, now we're going to sell you a whole bunch of other products, a mortgage, life insurance, all this other stuff, and we're no longer fiduciaries. We're not just going to mention it, and so therefore we're going to charge a commission. So they haven't fully adopted the fiduciary side of it, but the trend has been in that direction. And when you look at how money has been moving to the fiduciary side, to the registered investment advisory, unconflicted, fee-only side, I got the broad strokes right. I just can't believe it's taken the industry 30 years to get here, and they're still not there. Now, part and parcel of that is the move towards passive, the move towards indexing, the move towards low cost. Pretty much been on the right side of that for a long time. It was pretty obvious that it was coming. You had to read any book by Charlie Ellis, by Burton Malkiel, by Jack Bogle, and it's pretty clear the advantages of that. And the question that ties to that, and another big trend that's pretty obvious, is the ongoing fee compression. That is going to continue for a long time. And at a certain point, we'll eventually hit not quite a zero bound, but a reasonable limit. One of the things that I warn people about: cheap is really good, but watch out for free, because there ain't no free. There's no free lunch. And when a number of the trading firms went to zero commissions, I think the name of that was the exact name of the column I wrote for Bloomberg. And a perfect example, and Schwab isn't the only one who does this, a number of other companies do this. You think of Schwab as a big broker and a trading firm and an asset manager, but 59% of their revenue comes from the float on their cash. So they're in no hurry to get you to roll out of cash, because that's their bread and butter. So trading is free, but it's not really free. There's a cost to it. And you always have to look around and say, what keeps the lights on in this business at night? So anytime something appears to be too good to be true, anytime something is too cheap, you have to just stop and say, what's going on here? How am I paying for this? Because everybody who goes to work there and has a job and they pay the rent and they keep the lights on, somebody's paying for that. The question is how? Is it disclosed and obvious, or is it sort of buried on footnote 97 on page 142? It's an issue. So that's another trend that's been going on. And something that I've kind of modified my perspective on over the years, I've been pretty critical about alternatives. namely hedge funds, venture capital, private equity. You run into a problem with all of them in that we all know what the big winners are retrospectively, but out of the 11,000 hedge funds and 8,000 private equity funds, hey, tell me which one is the winner for the next 20 years, not the last 20 years. And so that's really a challenge. The way I've kind of evolved my perspective is recognizing that there's some persistence of process and managers, less so in venture capital, by the way. A lot of the big well-known venture capitals from the companies from the 80s and 90s that really just killed it in that generation, not doing so well the past 10, 20 years. So you have to look at some of the newer ones, some of the more interesting ones that have demonstrated this century. I can't believe I have to say that. This century, a different group of venture capitalists seem to really be outperforming versus the 20th century. So private equity, I've kind of moderated my negativity towards, with the recognition that all of these alternatives, in fact, any financial product, anything you could buy in finance or out, is very much subject to Sturgeon's law, which is 90% of everything is crap. And if you look at the bell curve distribution, grades are distributed in a nice even bell curve, but that's not how performance is generated. There's a fat head and a really long tail, and most of the products are on the far end of the long tail. So when you're selecting things on behalf of clients, and we have clients come to us all the time and say, what about this? What about that? You don't want to just shrug and say, no, it's junk, but you want them to be aware of the fact how challenging it is to pick anything along those lines. It's prospectively, it's very difficult. There is a skunkworks project going on at Vanguard where they're trying to find a way to bring, especially with equities relatively pricey and bonds yielding relatively little, they're looking for uncorrelated asset classes that might have a slightly higher yield. Arguably, the top third of private equity fits that, or the top 20%. And when you're Vanguard size, it gives you access to the sort of funds with the sort of process and track record that is worth exploring. And so I'm kind of watching how that develops. I don't believe I have the ability to pick which of the 8,000 buyout firms and private equity firms are going to be the winner. In fact, I don't think I could pick 100 and out of the 100 have 20 be a winner. But if I can have Vanguard do that on my behalf with their muscle, I would certainly consider that an option. And so I'm watching that very closely. It's really intriguing.
Awesome. So again, I just want to kind of switch gears a little bit here and talk a little bit about Ritholtz Wealth Management. So going back a little bit, what kind of inspired you to venture out, start Ritholtz for yourself? And obviously you had partners in that, Josh Brown, and I think Chris Venn was in there as well.
Mike Batnick, the four of us.
Yeah, Mike Batnick, of course. So what kind of got you on that track to start your own firm?
If you enjoyed this podcast, please be sure to tune in next week where we finish part 2 out of 2 of our podcast with Barry Ritholtz. Hello, everyone. This is Vincent Picillo, producer of the MSU WMA podcast, where we are inspiring and educating the next generation of financial planners. Thank you for listening to today's episode. If you enjoyed it, please check out our channel on all platforms such as Spotify and Apple Podcasts, and check out our social media at MSU WMA and MSUWMA.com.